Liquidity. All right, this is Abe Forest here. Today I'll be discussing about liquidity and the new IPOs. For over 4 years ago now, there hasn't been boom in the IPO market, which means that several companies have not been coming out to issue out their shares to the public. But in recent times, this year 2026, things are different now, and we have like 4 IPOs that massive IPOs that are supposed to come to the market, to the public this year. SpaceX is number one that come to mind when we talk about the new IPOs in USA, which they're trying to raise over $75 billion. And mind you, for the past 4 years, the biggest IPO that came into town was just Facebook in 2012. That was almost like some years back. So that was, since then actually experienced major big IPOs, unlike other IPOs that just came that didn't really hit the ground running. But now the reverse is the case. The last 4 years, each year or each IPOs, total of all the IPOs were able to generate like $30 billion each, for each year. And if you total that in 4 years, that's just $120 billion that was generated from the market. And the reverse is the case. In just 1 year, we have the SpaceX IPO that want to generate $75 billion. We have the OpenAI, which is ChatGPT, that want to generate $60 billion. We also have Anthropic, which is behind Cloud, that want to generate like $20 billion. We also have the Stripe, which is the payment system, that also want to generate $10 billion. All in all, we have $165 billion that want to be generated in the US stock market. That's not coincidence. And each of these companies, or let me just totaling, the valuation is over $4 trillion. And if you look at in the last 4 years, they were able to generate just $120 billion in the IPO market. So it's a sign that the IPO is booming this year. So, and the question we need to ask ourselves is that, where is the money going to be coming from? We are calling all this money. Is there enough liquidity in the market? When I talk about liquidity, I'm talking about money. So is there enough money in the market to actually power this market? Yes, there is. The stock market generally, US stock market, is $77 trillion, as a whole. Likewise, the Nasdaq is trading, which is the US tech indices, the US 100 is trading kind of $500 billion on a daily basis. Meanwhile, the New York Stock Exchange is trading nothing less than $600 billion on a daily basis. So totaling that together, we are having nothing less than $1 trillion in just 1 day. So the market is capable of getting this IPO that is worth $4 trillion, the valuation, and that means that they can actually generate $165 billion like they intend to generate. The SpaceX has already generated more than 80 something billion as of the time I'm making this video. So they intended to generate $75 billion, but right now they've generated more than that. Now let me use SpaceX as a case study. SpaceX comprises of 4 companies. We have the rocket, which is a space company that the total addressable market of this SpaceX this rocket market is $28 trillion. So that means that in the next coming years they are going to be generating more than $28 trillion, maybe next 10 to 15 years, or not up to 15 years anyway. So that is what the owner Elon Musk said. So which is called Starship. Okay, so we also have the Grok, which is XAI. So that is the AI company of this company, and also have the Starlink, which is the broadband internet that is being circulated all over the places. And these 4, and also we have X, which is the former Twitter. So these 4 companies are coming together to form what we call a SpaceX, and it is the valuation is $2 trillion. And people are asking, is this an overhyped valuation, or it is actually worth it? though Starship didn't really make the revenue, they had deficit in their revenue, but other companies made profit, so was able to cover up for the losses that has happened in Starship. It's just a rocket company that is trying to go to the space, and they've not actually gotten their feet up, as the case may be. So, and the SpaceX is going to be trading for like $135 per share. So many people have bought it anyway, and the stocks is doing very well until when the Fed increased didn't change the interest rate, and the stocks is kind of coming down. So this stocks was $135 per share and went up to like $228 per share, but now it's coming down. So probably we're going to see kind of run up to the top very soon. But that's not where we're going. The question now is, this money that we are calling, where are they all coming from? It is well known that new money is not being created, and Kevin Walsh, which is the new Fed chairman, is an hawkish type of Fed chair, which does not favor liquidity easing, or let us say quantitative easing. He likes to tighten up things because, from his own school of thought, he believes that inflation rises because of too much money in circulation. So the monetary policy, whereby there's much more quantitative easing, is going to cause more of inflation. So he believes that there's money in the economy, that he needs to tighten it such that inflation is going to be curtailed, according to his own school of thought. But the previous share persons, the person of Jerome Powell and the rest, they believe they have cut from 2008, since the financial crisis that happened, the global financial crisis that happened in 2008. They have been cutting interest rate and be putting there has been quantitative easing, but meanwhile it is causing inflation, and the benchmark for inflation is just 2%. But at the moment you're having more than 3.75% of inflation rate, which is much more than the benchmark. So that's one of the reasons why he is being hawkish in nature, thereby holding interest rate, not increasing it and not reducing it. That's the person of Kevin Walsh. But the question is, where does this money come from? All right, so I was asking that, where does this money come from? It's a question we need to ask ourselves. Since new money is not being created, where is this money coming from? And we need to understand the fact that there's what we call dilution versus capital absorption. So this happens when dilution happens when a publicly traded company issues new shares in the market, diluting the value of existing shares. It simply means that the existing shareholders who do not buy new shares see their ownership percentage decline. So it means that new money is not coming in. The existing shareholders has to give out part of their shares in order to curtail the new shareholders that want to come in. You understand? That is dilution versus capital absorption. That is what we call dilution. But when we say capital absorption, this is a process whereby the large new stock offerings pull money out of existing financial markets as investors sell existing holdings or redirect cash to purchase newly issued shares. It means that they will have to sell part of their portfolio so that they can get money, and reinvest it in the new IPOs. No new money is coming in unless for external or foreign investors that are coming with new money. But when we're talking about capital absorption, it means that you have to, that's one of the reasons why I found out that when the S&P 500 was going up higher for like 9 weeks after the war, during the war, but when quarterly earnings came in, it was, favorable than expected. You find out that the stock market is ripping up higher. For complete 9 weeks there was gains, and all of a sudden when they announced the SpaceX IPO that came up by June 12, you notice that people started selling and taking profit from those S&P 500, Dow Jones, and Nasdaq. People started selling off or taking profit so that they can invest it in this new IPO. So that is capital absorption. You are reducing or taking profit or reducing part of your initial portfolio. No new money is coming in. You are reducing part of your initial portfolio in order to invest in another portfolio. The money is still in circulation. The money is still in the economy. Like, it's not moving out of the economy, it's still there. You understand? So that is what we call capital absorption. But when we say dilution, it means that part of existing shareholders have to give up their shares so that new persons can come in. You understand? And the percentage of the shares is just going to reduce, but the total money in the share still remains the same. So, but your percentage is going to reduce. That is what we call dilution. Existing shareholders' percentage are going to reduce so that they can bring in new shareholders. That is dilution. You understand? So, unlike capital absorption, and the question we need to ask ourselves: what is the IPO capital structure? Then you need to talk about the institutional rebalancing. You need to talk about retail liquidation. You need to talk about sovereign wealth. Now, when we say institutional rebalancing, it means that institutions, all over the whole world are rebalancing their portfolio. You understand? Institutions are rebalancing their portfolio. Now, let me put this in good context. That means that a large asset manager running an equity portfolio that wants meaningful exposure to new IPOs, must trim existing positions and potentially use existing cash or raise new funds to create room for the new holdings, that's the new IPOs. While selling by any manager is unlikely to create a ripple effect in the market. So that is what institution rebalancing talks about. It means that you are taking money from your initial portfolio, like I made mention in the earlier message, that you are taking profit so that you can invest in this new IPO. Then when we talk about retail liquidation, so this is when an individual investor who wants to participate in an IPO needs cash to do so. So some of the cash may come from their savings, or it's different from the institutional account, institutional rebalancing. You understand? And the third one is sovereign wealth. That means from your pension funds or maybe foreign institutions try to come in, to invest. That is when the new money is coming in, but the money in circulation has not actually left the economy. That is the liquidity that we're talking about. So if you have any question, you can actually ask in the comment section or go through this pamphlet that is on your screen right now, so that you can understand it far more better. Alright guys, I'm going to see you guys in another episode. Bye.